I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. It's the ultimate guide to help you, the investor, make smarter decisions for your portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
We got a jam-packed show for you here this Thursday morning. Stock futures ticking slightly higher in reaction to the latest inflation reading. Annual core personal consumption expenditures, known in your hood as PCE, matching the street's expectations, falling to the lowest level since March 2021. We'll have commentary from the central bank as well throughout the day, including Fed officials Waller, Bostic, Goolsbee, and Mester.
And that is not all. We've certainly got a mountain of earnings that we are going to dive into this morning. Paramount, Salesforce, Birkenstock, Anheuser-Busch, and Best Buy, just some of the names on your screen right now, all trending tickers on Yahoo Finance's homepage. So let's get right to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Brian Zazi, and Jared Blickery have more.
Hey, Shauna, stock futures ticking slightly higher on the latest inflation reading. The Federal Reserve's preferred inflation gauge, Personal Consumption Expenditures, or PCE, ticked slightly lower in January, matching Wall Street's expectations and hitting its lowest level in about 3 years. The PCE index grew 2.4% year over year in January, a decline from last month's 2.6% print. And core PCE, which excludes the volatile food and energy categories, came in at 2.8%, down from 2.9% in the month prior. Markets now pricing in 3 interest rate cuts, staying steady with their pricing from before this print for the year of 2024.
Software stocks lighting up the Yahoo Finance ticker pages today. Heavy hitters Salesforce and Snowflake delivered a few surprises to investors in their earnings reports. Salesforce issuing revenue guidance for fiscal 2025 that came in below estimates, but margin guidance that came in above estimates, as CEO Mark Benioff continues his focus on controlling costs. And over at Snowflake, it issued weaker than expected guidance, along with appointing former Google executive Sridhar Ramaswamy to replace the hard-charging billionaire Frank Slootman as CEO. Investors are acting accordingly. Snowflake shares are getting smashed, while Salesforce is seeing minor profit taking.
And Bitcoin back on the rise this morning, the world's largest cryptocurrency, briefly spiking above 64,000 on some exchanges Wednesday morning before pairing gains early Thursday. Now, the roaring crypto rally is tracking the highest momentum seen since 2022, and it's helping Bitcoin surge to within spitting distance of fresh all-time highs.
The Fed's preferred inflation gauge out this morning. Yahoo Finance markets reporter Josh Schaefer here to break down the numbers and what it means for monetary policy. Let's talk a little PCE.
Yeah, Brad, so PCE out this morning, and the numbers coming in largely with what Wall Street had expected. Wall Street had expected this number, like the CPI number, to be perhaps a little bit hotter than people were hoping for maybe a month or so ago. So the PCE number year over year coming down to 2.4%. That's down from 2.6%. And then you're taking a look there on your screen at core PCE, which is really what the Fed looks at here. That excludes volatile food and energy categories. Core PCE coming in at 2.8%. Now, a key number sitting on your screen right now that I think a lot of people are going to be talking about here, guys, is that month over month number, 0.4%. We haven't seen a month over month increase like that in a little while now. This is going to push the 6-month annualized rate, which Chair Powell himself even recently talked about, and that's been a hot topic. That was below 2%. Well, the 6-month annualized rate is now going to come above 2%, which of course is our goal here. It's going to be above 2% based on this. Should note overall, it doesn't seem like the market is taking a big hit on this print, because again, it was largely in line with expectations. When we think about the moves we've seen in Fed rate cuts over the last month, we went from people expecting 6 cuts a couple months ago to people now expecting 3 cuts this year. We've sort of already had our big shift. So it doesn't seem like this was necessarily a massive market moving event, at least to the downside, to start the day here.
All right, Josh, thanks so much for teeing up the conversation here. Inflation still remains sticky. Prices ticking higher in January on a monthly basis, but the annual increase in inflation was the smallest in almost 3 years. The path towards the Fed and their 2% inflation target, it remains bumpy. For more on the Fed's preferred inflation gauge, we're joined by Michelle Girard, who is the CEO of NatWest Market Securities here. Michelle, just first and foremost here, I mean, we're going to get a lot of Fed speak as we move on throughout the rest of today's trading session as well. How do you think a print like this shifts what we may hear in some of those planned remarks?
Well, I think what we'll probably continue to hear from Fed officials is that they want to be patient. They want to have more confidence that inflation is sustainably moving toward that 2% target before they cut interest rates. You know, since the start of the year, when the market was initially very optimistic about aggressive rate cuts, we've seen the Fed kind of pushing back, and with the data coming in, as you said, on the inflation front, more bumpy than the Fed would like to see. That message has been consistent from the Fed that yes, you know, the peak in rates may be in, but the timing of when they can cut is something that they want to be patient about, given the fact they want to have confidence inflation is in fact going to get down to 2%.
Michelle, do you think that patient approach, does that make sense? Then at this point, it sounds like that maybe is the case. And then when we talk about getting eventually back to that 2% target, what do you think that is going to potentially look like?
So I do think it's certainly, you know, the Fed being cautious and wanting to have confidence that inflation is moving lower. And I think it's also tied to, you know, some confidence that the economy is going to kind of remain at a slower pace, in particular that the labor market and some of the wage inflation that is, kind of keeping inflation elevated will moderate. So I understand the need for patience, but also, you know, we have to remember that policy is pretty restricted. The Fed they raised interest rates very aggressively, over 500 basis points. We're looking at a funds rate at 5.5%. We're not talking about the Fed cutting rates to gas the economy. We're really talking about the Fed cutting interest rates to take their foot off the brake, if you will. And so, you know, I think that, to some extent, while it's good to be patient, it isn't as if, you know, there's a lot of room in terms of just taking your foot off the brake that the Fed could start to do well before you actually hit the 2% target, which we think is a 2025 story.
Of course, some of the thought that's permeated is, why isn't a two handle enough? What is the trend that the Fed is looking for here from your purview?
Yeah, I think that's exactly the point is, you know, the Fed doesn't want to wait till they hit their target at 2% to start lowering interest rates and getting policy back to a neutral stance, because policy takes a long time to work. So the Fed should be moving in anticipation of hitting that 2% target. And this is why I'm saying it's good to be patient, but there is a balance here to be struck. And so arguably, you know, just having that handle, if you will, dropping below 3%, I think has put the Fed in a position where they're rightfully thinking about when the Fed should be cutting interest rates. And this is the balance that they have. They just want to be confident that inflation isn't going to reaccelerate, that by the Fed taking their foot off the brake, it won't actually lead to a reacceleration in activity and the economy, a reacceleration in inflation, and the Fed having to reverse course. So this gets back to them being patient enough to ensure they're close, they're firmly enough on that downward target that the conditions around it in terms of the economy are conducive for inflation continuing to move lower, even as they take their foot off the brake.
Michelle, let's talk about what all this means then potentially here for the labor market. We'll get that reading next week, but jobless claims here this morning coming in a bit higher than what the street was expecting, 215,000 new claims for the most recent week. Are you expecting to see much of a deterioration in the jobs market, or how do you see that playing out as the Fed keeps rates higher for longer?
Yeah, as the Fed is holding rates higher for an extended period of time, we are concerned about the economic impact, and we do think we'll see a downturn in the economy later this year. Although, in full disclosure, we would have thought with the level of interest rates that we're at now, we would be seeing more of a slowdown in economic activity already, and that really hasn't materialized. We are seeing some loosening in the labor market. It's not as hot as it was, but it's still pretty resilient. And I think this is one of the things that the Fed themselves are very watchful of. As I mentioned, I mean, the labor market is still sort of tight enough that wages are firm, running close to 4%. And I think that I do think we will continue to see the labor market loosen up. We will see some of those wage pressures ease. As I said, we think the unemployment rate, particularly as we get in the second half of this year, will rise. All of this, and certainly giving the Fed the justification that they need and the confidence they need about inflation to actually lower interest rates.
All right, Michelle Girard, always great to get your insight. Thanks so much for joining us here this morning.
Thanks so much. Nice to see you.
You too, CEO of NatWest Markets Securities. Stay tuned right here on Yahoo Finance. Our very own Jennifer Schomburger is speaking exclusively with Cleveland Fed President Loretta Mester. That's coming up on Yahoo Finance at 3:30 p.m. Eastern Time today. You won't want to miss that. Another big story that we are tracking is Salesforce joining the likes of Meta, the latest tech giant, to declare a dividend. It is a sign, obviously, of management's confidence in the business. Now, Yahoo Finance's executive editor, Brian Sozzi, has the analysis on this, and we're looking at gains right now, Brian, of just about 1%.
Volatile trading, Sean, I should say. Initially, Salesforce shares ticked lower last night after earnings. Ahead of that Mark Benioff earnings call, we're seeing that reverse a little bit more here in the morning. I have more on this now on the Yahoo Finance blog. I encourage everybody to go to our homepage, check it out, and hear some thoughts on this one. But why we're seeing this volatility, let me just check this off real quick. Really, you go into that earnings call, really well received by Benioff last night, talking about some weakness in the consumer parts of the business for Salesforce-related products. Revenue guidance slightly below consensus, about 1% to 2%, depending on what numbers you're using. And then billings performance, or the billings guidance, a little bit below where some folks had their estimates. But I wanted to tick through these things really quick, because I think that is missing the bigger story here and why you're seeing that reversal in some of the stock. Let's look at a 5-year chart over at Salesforce that I think will help fill this out a little bit more here. Giant big board. If you look at the early part of 2023, you can see Salesforce shares really were at the lows, at levels many investors that have bet alongside Mark Benioff have never even seen before. But from 2023, this stock has been up in really a straight line as Benioff has clamped down on costs, driven a lot of margin expansion. And importantly, those stories that have driven Salesforce shares higher over the past year, that continued in the earnings call. So take a listen to what Benioff said about where Salesforce is today, where it has come, and ultimately where it's going.
Look, it was over a year ago. We said Salesforce had to transform, and many of you came to me, came to our whole team, and you said, look, we're going to transform the whole company. We did it together. We could not have done it without you. We said we would restructure our business for the short and long term. We did that. We said we would place a laser focus on increasing productivity and operational excellence from across the board. We've done that. We said we were going to double down on innovation to make our core products even better. We've done that.
I've got to spend a lot of time with Benioff really over the past year and a half, and I've watched him transform the company yet again. And it's not me being Pollyannish, it's watching transformation in real time. And I think the street underestimated how serious Mark and his team were, and even CFO Amy Weaver, were about cutting expenses at this company and running a more shareholder-friendly entity after a lot of investors attacked them. But here's another checklist that I wanted to bring up for you as you guide yourself through this Salesforce earnings report. New buyback, very important. Another big tech company, well, a little bit older big tech company in the vein of Meta, initiating a dividend for the first time, 40-cent per share dividend for our Salesforce. Also announcing a new $10 billion stock buyback plan. Those are very shareholder-friendly actions by the team over at Salesforce. Secondarily, the company is innovating fiercely in AI. Mark teed up another event next week where they are likely to unveil a host of new AI products. Historically, the market has liked these announcements from Salesforce, especially now they have an idea on the pricing for these products, which Salesforce released late last year. And then, as I mentioned overall here, guys, it has been a true, I would say, cultural and business model reset for Salesforce. They outlined 200 basis points more in operating margin expansion for the next 12 months. That's in addition to everything they drove in terms of margin expansion in the past past year. The street likes that. I think that's why you're seeing reversal. But as I'm reporting on the story in real time, guys, I'm going to go back on the Yahoo Finance live market blog and get some more thoughts out there. It's just a big day for Salesforce. Why not?
All right, Saz, appreciate the breakdown there on Salesforce. We're going to continue the elements of the conversation as well later on in the show. Fred Havemeyer, who is the Macquarie head of U.S. AI and software research, going to have that conversation with us, Saz. Appreciate it. Let's pivot here and talk a little Bitcoin. Bitcoin continuing its rally today. This week, the currency has flown past 63,000 for the first time since November of 2021. For more on what we can expect, Yahoo Finance reporter Jared Blickery here to break it down. Hey, Jared.
Hey there, it's almost a slam dunk now that we get past those record highs, which are right on the upper end of 69, 70,000, depending on your exchange. Here's what Bitcoin has done over the last 7 days. Easy to forget, only Monday, it was in the low 50,000s. Now we're tracking nearly 64,000 overnight. We backed off just a tiny little bit from those highs. Ethereum also joining the party here, up 16% over the last 7 days. And overall, let's take a look at the 5-year chart because we can see Ethereum, too, a little bit farther away from these record highs, but a very similar chart structure. And one of the things I've noticed of late, and let me put a 5-day view on the heat map, we can see some of the outperformance now in the fringe tokens. So here's Dogecoin, off my radar for a bit, but here's a 5-year chart, much different chart than we were just looking at with Bitcoin and Ethereum, still in the lower end of its range here. So we'll see if it can get off the ground and maybe catch up a bit. But I think it just speaks as to the speculative fever that we've seen. In the last 5 days, tech is still the #1 sector, followed by consumer discretionary. So we've seen, even in the fringier parts of the market, whether it's ARC innovation components or IPOs, there's just a lot of hot money, a lot of thirsty cash waiting to be deployed.
We certainly are looking at that now with the massive surge that we've seen. I think the big question is whether or not this rally can hold and how much higher we're going to go if we do press above those record levels. All right, Jared, thanks. We'll keep right here on Yahoo Finance. Much more to get into this morning. Coming up next, Paramount touting strong growth in streaming despite declining revenue. You're still, though, looking at losses in the pre-market of just over 1.5%. We've got more of Yahoo Finance's trending tickers next. Paramount shares climbing higher, up just about 3.5% in the pre-market after posting a surprise profit in the fourth quarter, boosted by a 69% jump in streaming revenue from just a year ago. Now, the media giant also announcing that it expects to achieve profitability for Paramount Plus in 2025 in the U.S. For more on these results, we want to bring in Robert Fishman. He's MoffettNathanson, a senior analyst. Robert, it's good to have you here. So certainly it looks like shareholders, investors are pleased with these results. What's your first take on Paramount's most recent earnings report?
Yeah, good morning. We think it was a kind of inline quarter. I think it speaks to what you just touched on. Clearly, they're very much focused as one of their key priorities this year in terms of reducing the losses and trying to hit profitability. They gave guidance for 25 to hit U.S. streaming profitability. And really that they're doing as well as they can, but there are still significant challenges out there in the industry that they have to face.
What is the likelihood that they can navigate those challenges without an acquisition or a merger?
I mean, that is the key question here. Clearly, there's been lots of speculation over the past few months in terms of those potential partnerships and different exit strategies for the company. With public and probably more private bids too. Ultimately, it comes down to the appetite that any acquirer wants to take on, the risk that comes with that because of the secular challenges facing the traditional TV ecosystem with advertising headwinds and cord cutting, everything that we're all familiar with. But really, the question is, what is the value of these assets? And what's the value to different parties involved?
Robert, anything in this report, does it change at all the position of Paramount, given the fact that it is obviously at a disadvantage when you compare it to some of the leaders within the space?
Yeah, I'd say that the biggest disadvantage is really the lack of cash that the company produces. They did surprise, if you want to call it, a little bit to the upside in terms of expectations, with free cash flow growing slightly over the positive cash flow that they got to in 23. So, you know, that is, I guess, a step in the right direction. But just relative to most of these other media companies out there, there's just really not a lot of free cash flow that the company is producing, which again puts it in a challenging position given the debt and the leverage here.
I mean, this really seems like a company that is trying to get that direct-to-consumer profitability, cost synergies here, but that has been achieved by some of its other competitors by also announcing some of the advertising tiers, and we're seeing that digital advertising landscape really kind of heat up here. What does that flow through mean for Paramount, and can they attract the same type of advertising spend that some of those other major competitors are doing?
Yeah, it's a great question. I would say they're still ramping up there and are talking about the fact that there are opportunities there. They also have the other asset, Pluto, which is one of the fast channels. And it seems as if growth has slowed there, cooled off at the very least. So they're definitely pushing more on the Paramount Plus advertising tier. But as I'm sure you well know, so are everyone else, and especially with Amazon now in the marketplace and Netflix ramping up and Disney Plus ramping up. There's just a lot of competition for these streaming ad dollars.
Yeah, we do know it well. Robert Fishman, MoffettNathanson, senior analyst. Thanks so much for taking the time here with us today, Robert.
Thanks a lot for having me.
You got it. Another trending ticker that we're watching this morning, hiking beer prices might be paying off for Anheuser-Busch. The company saw revenue rise in 2023 despite an overall sales decline. Revenue in the U.S., however, declined by 17%, due in large part to some of the Bud Light boycotts. Joining us now with more, we've got Yahoo Finance's Brooke DePalma. Hey, Brooke.
Good morning, Brad. Good morning, Sean. I mean, certainly what a year for Anheuser-Busch. The company did post a profit in Q4 and hit record revenue for the full year. But let's take a closer look at how the company shaped up in the last quarter of 2023. Quarterly revenue did increase to $14 $1.47 billion, slightly below what the street expected due to those higher prices that were largely offset by the performance here in the U.S. that are continuing to lag, shaping into 2024 as Bud Light tries to turn that corner following the boycott that lasted throughout 2023. And believe it or not, that was more than 11 months ago come next week. And here in the U.S., we did see volumes drop. We saw volume decline 2.6%. That was more, or rather overall volume decline 2.6% last quarter compared with the 1.48% drop that Wall Street did expect. And here in the U.S., revenue did come in lower, down 17.3% last quarter, as sales to retailers, well, they dropped as well, down 12.1% due to that poor performance of Bud Light. And sales to retailers is something that we'll continue to watch, especially as these retailers shape up their shelves come March and April for that critical May, June, July, summer months that are so important for the beer industry. On the call, AB InBev CEO really acknowledging this, saying that it was a challenging year for the business here in the U.S. He did say that it continued to improve gradually from May to the most recent weeks in February, and they ended 2023 with their market share at 38.3% here in the U.S. All this while that strike was averted yesterday evening. They did reach a tentative agreement with the Teamsters.
Certainly. So it looks like they are righting the ship just in terms of that market share and getting back some of those lost sales, but they certainly do have a ways to go coming off an extremely challenging year for the business. Brooke, thanks so much. Well, the opening bell on Wall Street is just a couple of minutes away, 5 minutes away. We will take a closer look at how investors are digesting that latest inflation print from the Fed and what it means for your portfolio next. Two trending tickers on Yahoo Finance this morning that are moving actually in opposite directions. Snowflake up first. You're looking at losses of just about 20%, falling sharply after the company projected annual revenue below the street's expectations. Also disclosed a surprise retirement of its longtime CEO, Frank Slootman. Now, on the flip side, taking a look at Okta, you're looking at a surge of just about 22%. The company posting a huge earnings beat and also raised its outlook. Madison Mills joining us now from the floor of the New York Stock Exchange with more on these moves. And Maddie, let's start with the negative and then get to the positive. This move lower first that we're seeing in Snowflake.
Hey, if you're the CEO retiring, there's no better compliment than the stock heading for its worst day ever after you announce that you're leaving the company. And that's exactly what we're seeing with Snow heading into the market open. They are expecting to have their worst day ever. Now, this comes a couple of years after this company became the most successful cloud IPO ever right here on the New York Stock Exchange. So this indicates a little bit of the kind of expectations for forward guidance that we've seen on Wall Street playing out on this earnings print. Their earnings for the last quarter were pretty good. They beat on sales, they beat on revenue, both of those metrics up by over 30%. Still seeing the stocks plunging this morning off of that downward revision to the fiscal year 2025 guidance. That downward revision for something like product revenue, though, only missed by $9 million. So just think about how small that revision is. And the street's reaction is so severe. It indicates to me this broader picture that we've been seeing throughout this earnings cycle. Any name that's going to be relevant to this big tech rally that we've been seeing, and any name that's related to AI, is really going to have to prove growth on top of growth on top of growth. And that's what their competitor Okta was able to do. That's why we're seeing that stock heading for their 52-week high. If you take a look at this name on the Yahoo Finance platform listed on the Nasdaq, that digital security company issuing really strong guidance for the year ahead.
Maddie, thanks so much. We hear some clapping and cheering behind you there, so we know we must be close to the opening bell here, just seconds away as we're taking a live look at the Nasdaq and the New York Stock Exchange. There you've got to look at the opening bell. Up there at the NYSE, you've got Ryanair, not Ryanair, Ryanair, ringing the opening bell there. And then in Midtown Manhattan, you've got St. Jude's Children's Research Hospital. Excellent work that the team does over there. Got some funfetti fitting for the occasion there as well here. So St. Jude's Children's Research Hospital ringing the opening bell there. Kicking off today's market activity here as we've got PCE that dropped this morning. You've got a slew of earnings that we were running through, and we've got a few more to get to. So all you consumers out there, stay tuned here. But they're just taking a look at the U.S. major averages, the Dow, the S&P 500, and the Nasdaq. As you're seeing this all open up, it's opening higher. Dow is up by about 0.2%. S&P 500, 0.4%. Nasdaq, about 0.75%. Maddie Mills is on the floor of the New York Stock Exchange. Today's PCE report, really, Maddie, showing inflation is in line with expectations, Maddie. However, investors, how are they reacting to the news down there?
Oh, everyone is thrilled, right? And it's interesting to see that we had two prints that were not as good as anticipated with regards to inflation coming in hotter than expected. Today's print coming just in line with expectations. Take a wild guess which one Wall Street is going to be focusing on today. Obviously focusing on that great news for them coming out of that PCE print. Emily Rowland over at John Hancock Investments this morning calling this the everything is awesome rally, and we're only seeing that continue after that PCE print. I took a look at what's going on in terms of pricing Fed rate cuts moving forward. Heading into the print this morning, it looked like there was about a 60% chance of a cut in June. That went up right after the print to over 65%. We also saw that yields were up heading into that print and came down a little bit after that PCE print as well. Now, I also want to take a look at some of the details within that PCE report because they talked about the big raise in income, over 1%. But if you look at what contributed to that, dividend income contributed over 4% to that headline number. That indicates to me a continued story of this bifurcation of the American consumer and spender. Not everyone across the U.S. is going to be getting a significant portion of their income from dividends, which we've seen announced from the likes of Meta, Uber, Stellantis, Bumble announcing more dividends as well. So we're continuing to see this dividend play playing out on Wall Street. I'm curious to see how that impacts consumer spending and how it continues to frame this story of two different consumers in the U.S. as we move forward.
Yeah, Maddie, you mentioned the traders on the floor being thrilled. I imagine that many of them may be thrilled that it's also Waffle Thursday at the NYSE, an occasion where I've overindulged on a cyclical basis far too much here. Thanks so much for taking the time, Maddie. Appreciate it.
What's Waffle Thursday?
Waffle Thursday.
Every Thursday or
every
just
Thursday.
Once a month?
No. Every Thursday.
Oh, wow.
Yes. Week in, week out.
Everyone participates or just?
I mean, anybody could get it. It's in the cafeteria down there.
Wow.
Yeah, good waffles.
Hopefully Maddie gets down there.
It might be too late. I think they shut off breakfast by 9:30. Anyway, we've got some retail earnings this morning, giving us another look into the state of the consumer. Let's start with Best Buy, giving weaker guidance than anticipated, despite beating earnings expectations for the fourth quarter here. One thing that kind of jumped out at me was that they're banking on a year of sales stabilization for the industry. They also laid out some of the bad news first here. From a merchandising perspective, the largest drivers of the comparable sales declines on a weighted basis: home theater, appliances, mobile phones, and tablets. I know what you're thinking out there. What's left in the store? Well, gaming. That was the only really element that kind of offset some of those declines that they had seen, especially in the North American market.
Yeah, they are making some progress here when you take a look at the shares reaction and why we're seeing a bit of a bump. Yes, Best Buy has a number of challenges like you just laid out there, Brad, but certainly this might be a step, at least in the view of investors, shareholders, in the right direction here, just in terms of that 2-year slump, the soft demand that we have seen. Maybe now we are starting to see a bit of a turnaround, but we got to put this in perspective, right? Because comp sales did still decline 4.8% in the fourth quarter, although that was a less than expected decline than what the street had been bracing themselves for, just over 5%. Adjusted earnings of $2.72, which beat the street's expectations. And then also when it comes to that full year guidance, we know the company projected comp sales is going to range from a decline of 3% to flat here in the current year of fiscal 2024. They previously lowered their 2024 sales guidance back in November. So all in, this report at least better than what the street had been bracing themselves for, and that's why we're seeing shares move just a bit higher today. Let's also get to another retail name that we are closely watching, and that is Birkenstock, showing revenue growing 26% from a year ago as demand in the U.S. strengthens. And this is just another name here showing that consumers are still out there spending, Brad. They're spending it on footwear that can cost a couple of $100. So this isn't exactly the lower end or midpoint of this range. These are people who are willing to pay up for some of this footwear, which is controversial whether or not you're actually should be paying that much for a pair of sandals. But what I will point out and say is that this is a company that a lot of people are questioning what the growth metrics look like going forward, what exactly the scale and opportunities to scale look like in the future. But laid out in this earnings print and on this earnings call was a number of initiatives. And you can see Europe a standout within this report, up 33% on a year-over-year basis.
Yeah, I caught a lot of flack within our newsroom for saying that you could get the same thing at Walmart or a Target. And I hear you out there. It's not exactly the same, but at least for me, mine still work. Birkenstock, though, I think one thing that jumps out, though, the clog trade flexing its legs here over the year-to-date scale. If you really think about how Birkenstock has been able to kind of add on and see where their merchandise can expand further, where they can continue to tap in to, and now on a year-to-date scale, they actually are down on this move here. So interesting. But over the past 52 weeks, it's been an interesting move to the upside that I've been continuing to keep an eye on. One of the things that I think investors might be looking at here that the company laid out impacting some of that midterm profitability is how this company is going to spend further into its operation. They talked about achieving the above industry average full price realization, but I think at the end of the day, there's a lot of focusing in on the strategic investments into future growth, having a planned temporary impact on profitability here.
All right, well, let's get to one of our other big stories of the day, the big story of the day for the market, and that's the latest print on inflation. PCE inflation report out this morning, meeting the street's expectations, coming in line with the street's expectations. Here to break it all down, we want to bring in Michelle Schneider. She's MarketGauge.com chief strategist. Misha, it's great to have you. Let's talk about the reaction that we're seeing play out to this inflation print. Yes, it was in line with what the street had been bracing themselves for. We're looking at gains here shortly after the open. How much of the inflation trend has already been priced into the market?
Well, that's a really good question, because in terms of whether or not we can argue that actually inflation bottomed back in October when we're now starting to see upticks in CPI, PPI, the fact that PCE came in line, does that mean now that whatever little blip we had rising in inflation is now over and it stays stayed is, certainly something that I would not necessarily get too comfortable with. Two reasons. Number one is because if we go back and look at the overlay charts, which I have shown over and over of the 70s and what's happened concurrently, is we saw all of the inflation numbers come down into 77, just like we've seen them come down from 22 to 24. And if the predictions are correct and we start to see any kind of loosening of monetary policy as we get towards June, was kind of exactly at the same time when we saw the trough in the CPI in the 70s, could be the trough that we're seeing right now in PCE CPI in the 2024, and we could start to see, with any loosening, the inflation numbers rise. So I'd say be happy now in terms of the inflation that it hasn't gotten out of control, but I wouldn't get too complacent still.
How does that lean further then into the higher for longer stance that the Fed may deploy?
Well, there's always two ways to look at things, and that's what's making the market so fascinating right now. And in terms of the Fed, if they kept things exactly the way they were and everything stayed exactly the way it was right now, like I almost think about a holiday photograph. When you look at the family and they're all looking very, very happy and it's that moment in time, that's kind of where the Fed is at right now. They haven't destroyed the economy like many people predicted, and they have possibly curbed inflation. So we could be at this perfect moment right here. So the higher for longer makes sense if we don't start to see more recessionary factors, which so far we've managed to avoid. However, what will happen if we actually start to see some kind of spike in inflation down the road? If Fed stays put, would that be enough? Because they wouldn't want to kill the economy, but at the same time, they don't probably want to raise rates unless they really start to see inflation get out of control. And that's why we're looking for specific signs why that might happen.
So we have inflation prints, we have the Fed driving the market action, and then you've also got earnings as we wind down this most recent earnings season here. On the fundamental side, Mish, what are you seeing there?
Well, in terms of the earnings, they obviously were better than what people thought. So this is exactly what we're talking about, right? That happy photograph. I'm pretty excited right now. I mean, besides the inflation conversation, I have my eyes on silver, I have my eyes on sugar, the normal ways you want to look at it in the dollar. Dollar stays it, that's good. Sugar doesn't go flying, that's good. Silver doesn't start outperforming gold, that's all good. What I'm looking at right now is what I call my economic modern family. And I think the earnings are starting to show that some of those areas, like you just mentioned with Best Buy, but in the consumer area are strong. And the retail sector, especially measured by XRT, strong. IYT, transportation, strong. And of course, my granddaddy, which is the small caps, are trying very hard right now as we speak to get through the December highs at 205.50 if you're looking at IWM. So what that tells me right now is the market is trying to stretch beyond tech and into some kind of growth. And what would make it grow? Two things. I think one is the vanity trade that I love to talk about, which is really spurred by these diet drugs that if they work can spill over into people going out and feeling better about themselves, spending money. And the other is the potential reshoring that we're starting to hear more and more about, where production starts to come back to the United States. So there's three trends we have to watch here, right? On the spur of what we see earnings is number one is obviously where inflation goes. Number two is how much the consumer stays happy. And number three is how much manufacturing and production can we bring back here and make our economy grow.
Modern Family, good TV show. Economic Modern Family, even better portfolio thesis. Michelle Snyder, thanks so much for taking the time. Great to speak with you as always. MarketGauge.com Chief Strategist.
Thank you.
Thanks. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Celsius shares trading higher this morning after reporting record fourth quarter revenue of $347 million. Now, that's up 95% from just a year ago. Now, the company did, though, however, see a slight pullback in sales from the previous quarter, though you are looking at share gains of 8% today. We want to bring in Celsius CEO John Fieldly. John, it's great to have you back here on Yahoo Finance. Another strong quarter here for your company, $39 million in net income. Talk to us just about where you are seeing that demand and how that sets you up then for the rest of 2024.
Yeah, no, thanks for having us. It's exciting. It's just a time to celebrate. We're now a billion-dollar company. When you see what we put up, over $1.3 billion, record revenues, record earnings, we see a long runway ahead. The timing has never been better. We're really changing the way people think about energy drinks. And right now, the category is about to flip, where 50% of energy drinks are going to be sugar-free for the first time in history. So really excited about that. And we're over a 10 share now in the energy category, which hasn't been done in the last decade.
And so when you look at how you're really playing into this category, it's really kind of gotten a lot of legs on the performance side of your marketing pitch as well. Why do you think that's working well with consumers right now?
Well, our DNA, we're all about living fit. It's Celsius Live Fit. It's about, accomplish your goals in the gym and outside the gym. It's every day. And some of the partners we partner with, we just renewed our multi-year deal with Ferrari, with F1. We partner with MLS on a national basis. We're really about inspiring people to be their best day in and day out. And that's what's in our DNA. We're also expanded into food service for the first time this year in 2023. We partnered with Jersey Mike's, and we just expanded into over 3,000 Dunkin' Donuts for the first time. So really exciting. People are consuming Celsius outside of traditional energy. So we really think we got a bigger play here than just the energy category.
John, pricing is a critical question, especially right now. We've seen Red Bull, we've seen Monster raise their prices. What does your strategy look like for that? Do you have any plans to raise prices?
Well, I think there's opportunities. We're a premium brand. We have a pricing architecture, promotional strategy we stick to. As we'll continue to evolve as we go forward. Right now, we're about growing revenue, bringing new consumers into the portfolio, and inspiring people to live their best life.
Okay, but I'm trying to live my best life on a budget here, John. So I need to know, are prices going up?
Well, when you look at it, we run a variety of different promos and deals. We'll continue to evolve. We'll see how the category goes. We're being very methodical, but I think when you look at price elasticity, we're part of a daily routine and a daily lifestyle. So when you look at consumers looking to cut something out of their budget, likely that, that extra trip to the restaurant, maybe that dessert, and those type of items, we're not really seeing that historically in the energy category.
John Fieldly, Celsius CEO. I've never seen an instance where you haven't had a Celsius in your hand, John. Always appreciate you taking the time.
Thank you.
Thanks. Coming up, shares of C3.ai popping this morning despite a beat on earnings. We'll dig into the market move with C3.ai CEO Tom Siebel after the break.
Shares of C3 AI soaring this morning after reporting a revenue beat and a narrower than expected loss in its fiscal third quarter. Now subscription revenue rising. That was up 23% from just a year ago. The report overall, another boon to the recent tech rally that we've seen, driven by excitement surrounding AI. We want to bring in Tom Siebel. He's the chairman and CEO of C3 AI. Also Yahoo Finance executive editor Brian Sazi joining us here on set. So Tom, it's great to see you again. Congratulations on another strong quarter here for the company. Sales up 18% from just a year ago. Talk to us a little bit more about what you're seeing demand-wise for AI adoption and what your growth prospects look like going forward.
Well, I think if we look at the enterprise AI opportunity writ large, I'm not certain we've ever seen a market opportunity this substantial. This might be the largest opportunity in the history of enterprise application software. And C3 AI has been kind of developing the platform and applications now for 15 years to address these opportunities in financial services and consumer packaged goods and defense, intelligence, oil and gas, what have you. So we're very well positioned to take advantage of this market opportunity, and business is good.
Tom, it's Brian. Good to see you again. Thanks for hopping on after earnings. I think investors still may not understand the progress you're making in terms of the federal business. I really enjoyed what you said on the call last night about the military, how you're expanding with our country's military. Walk investors through exactly what you're doing with federal business, even specifically within the military.
Well, AI is clearly a strategic mandate in defense and intelligence. And while they've spent much of the last decade trying to build these applications themselves, today they're relying on the private sector. So the projects that we're engaged in are, for example, predictive maintenance for assets and aircraft for the United States Air Force. That might be one of the largest enterprise AI applications in deployment on the planet. Contested logistics for Transcom, multi-domain command and control, common view of the battlefield where we're fusing data from high orbit sat, low orbit sat, drones, AIS, ground-based intel, so that the various combatant commands can get a common view of the battlefield. So these are examples of applications that we're involved in the Department of Defense, and they're strategic, they're important, and it's essential to the security of the free world.
Tom, it's very clear that customers of yours and some of your other industry competitors are trying to figure out how long a term of a contract it makes sense to sign on to while they're trying to discover the value that they're getting out of some of the either generative AI or just broader advanced AI solutions that are being marketed to them right now. What are you hearing from your team, and how are you kind of extracting the most value out of those potential and portfolio clients right now?
We're in the business of serving customers and delivering our customers, with the pricing structures that they want. So our customers have the alternative of licensing our products like month to month, in which case they just pay a monthly consumption fee for their usage based upon CPU utilization. Or many customers who are making kind of more strategic investments in C3 AI, multiple applications in multiple business units, will elect for subscription-based pricing, where they'll agree to multi-year pricing agreements to basically what this enables them is kind of more certainty in their cost structure going forward. So we're basically in the business of doing serving our customers and structuring our pricing models to meet each individual customer's needs.
Tom, the last time I saw you physically was at the World Economic Forum in Davos. That was just in early January, and the AI trade was hot then. Since then, it has been ratcheted up several gears. I look what NVIDIA reported a couple weeks ago. I look what even you guys reported here. The investor enthusiasm seems to have reached a new level. As someone that has managed and led through cycles like this, where are we in this cycle? And investors just making too much of this moment?
This is a secular change in the structure of the information technology business. It's difficult to overestimate, the power and the impact of AI. I think we're in, the first half of the first inning, and the first batter is, on his way to the plate. This is good. This is not ephemeral. This is very significant. It's very important, and it's going to be huge.
Tom, when it comes to, you talked a lot about the traction that you're seeing, demand that you're seeing on the federal side of things. You also have a large presence in manufacturing, state and local government, agriculture. I'm curious what you're seeing demand-wise from those other industries and where you see the most growth opportunity then going forward.
I think this covers, every aspect of the economy: consumer packaged goods, financial services, travel, transportation, entertainment, food distribution, manufacturing, oil and gas, utilities. I mean, this is a fundamental change, in the nature of the way that we're applying information technology to deliver, higher quality products at lower cost and government services into the hands of more satisfied customers and constituents at lower environmental impact. This is a genuine big deal, and there is no aspect of the economy that is not, fundamentally structured by the application of artificial intelligence.
Tom, I think you gave a masterclass and a really depth-full answer to the Morgan Stanley analyst yesterday on the call. I urge all of our viewers to go check that out. You did lose me at one of the big hobgoblins associated with large language models is data exfiltration, though. So I got to go back and wrap my head around that. Tom, thanks so much for taking the time here today. Appreciate it. C3 AI Chairman and CEO, and our own Brian Sozzi.
Thank you.
Thanks. Up next, we break pending home sales. Those numbers out at 10 a.m. Eastern Time. And we speak to Rajiv Ramaswamy, who is the Nutanix CEO, on the company's latest earnings report. That's coming up in the 10 o'clock hour. Welcome back, everyone. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Taking a look at the markets here, stocks trading higher after the latest read on inflation. PCE came in line with the street's expectations, the annual gauge falling to the lowest level since March of 2021. And shares of AMC also in focus this morning, falling after the company posted a higher than expected loss of 83 cents a share. The company did beat revenue estimates, though, helped in part by the distribution of concert movies, including Taylor Swift, The Eras Tour, and Renaissance, a film by Beyonce. Plus, Duolingo shares are in rally mode after the company posted a record quarter thanks to more bookings, revenue, and profitability. Duolingo said its daily active users rose by 65% year over year to nearly 27 million people. And finally, better ingredients, better earnings. Papa John's shares getting a nice boost today. The company reporting record system-wide sales. North America comparable sales were also up 2%. The company has been focused on growing its North America business. We should, however, note that the international comparable sales were down by 6%.
Let's get you some breaking news. Pending home sales falling 4.9% in the most recent month of January. That was down on a month-over-month basis, the biggest monthly drop that we have seen since August. Now, we're talking about this because it really is a key indicator, a forward-looking indicator for what home sales are going to look like here in the coming months when we talk about contract signings. Now, digging in even further on those month-over-month comparisons here, contract signings rose in the Northeast and in the West. They did fall, though, in the Midwest and in the South. Now, on an annual basis compared to a year ago, pending home sales, Brad, they're declining in all U.S. regions.
Yeah, we've got a comment here from the National Association of Realtors Chief Economist Lawrence Yun saying the job market is solid. The country's total wealth reached a record high due to stock market and home price gains. The combination of economic conditions is favorable for home buying. However, here, and this is the cold water, consumers showing extra sensitivity to changes in mortgage rates in the current cycle here. So pointing that out and pointing out how that's impacting home sales right now. And of course, there's a little bit of moderation in that regional breakdown here. Midwest decreased. You saw Northeast increase just a little bit there, and the South declined by about 7.3%.
All right, well, let's get a look here at one of the trending tickers, and that is GoodRx, popping today after reporting a fourth quarter revenue beat and Q1 and full year guidance that beat the street's expectations. Now, the telehealth platform also announcing a new buyback program of up to $450 million in common stock. Yahoo Finance's Anjali Khemlani joining us now with the CEO of GoodRx. Anj.
That's right. We have with us Scott Wagner, CEO of GoodRx. Scott, thank you so much for joining us today. Really a strong quarter and a strong full year earnings, up $750 million for the year. That's pretty good. You're on your way to $1 billion there, slowly but surely. But despite that revenue growth, you still reported net loss. And that is, of course, where the mixed earnings comes in, despite this beat and the investor sort of optimism there. What can you tell us about the balance of both?
Anjali, hey, thanks for having me. It's great to be with you. Well, first, we were really pleased with the results. Revenue was up 7%, EBITDA was up 15%, and importantly, the business is cash flow positive, so we make money, and all those financial measures are going in the right direction. And the best thing about all that is they're reflective of the work we've been doing over the last year to continue to fulfill our mission, which is to provide Americans with prescription medication that they can afford. 1 billion prescriptions a year, that's 1 billion with a B, get left at the pharmacy counter due to price. And GoodRx is really the way that people can get access to medication they need at a price they can afford.
That's right. And talk to me about, the outlook. I know there were some hits that you took towards the end of last year, resulting in that net loss. What are you looking at for the upcoming year in order to sort of regain some of that momentum?
Well, I think the nice thing, and I'd say it as continue the momentum that we're actually on. And we're really doing three things right now for the company. The first of which is working with our retail pharmacy partners, Walgreens, CVS, Walmart, et cetera, to help them manage their own category. One good example of that is Walgreens in the fourth quarter during cold and flu season. We took a basket of cold and flu medication and together with Walgreens, delivered 40 to 50% savings on this basket of drugs, merchandised them, and guess what? Walgreens got a ton of incremental activity and traffic. And so theme one is working with our retail pharmacy partners to continue to manage their category. The second thing, and this is interesting and has I think a lot of runway to it, is having the GoodRx benefit work with insurance. So the product is called Integrated Savings, and with a couple of pharmacy PBM partners, when you deliver your insurance card to the pharmacy counter, you check your insurance copay price and the GoodRx benefit, and you automatically get the lowest price. There's a huge amount of trajectory there in bringing what's a benefit of GoodRx against traditional insurance that we think has a lot of runway. And the third thing we're doing is working with brand medication to deliver GoodRx savings at the point of sale, all of which have a ton of opportunity.
Absolutely, yeah. This shared savings program, really an interesting way to sort of integrate and make it less painful for the consumer to have to do all the legwork there. Great buy-in. And at a time where we know that pharmacies are sort of hurting when it comes to sales of prescriptions, pushing into mail order and the like, talk to me about how you think about the technology overlay on that. And in a world where we're talking about AI and how the company is looking at sort of this rush of innovation right now.
Yeah, thank you. That's a great question. I think the first part of it is we're working really closely with and for not just our retail pharmacy counter partners, but the industry in general to really add tech benefit to the flow of a prescription, which is all designed around people, patients, which how do I not only get that prescription medication, but have the right point of affordability? And so there's connection from your doctor's office to the flow of the script to your, frankly, insurance plan to retail. That's one of the big things and big advantages that we provide. Relative to AI, there's a heck of a lot of immediate opportunity in that pricing benefit that we're already working on and leading the industry on. And kind of like what Tom Siebel just said a few minutes ago, there's a lot of runway here, and we're kind of at the forefront of healthcare pricing, particularly to allow that benefit to work its way into the hands of people.
Yeah, one of the things that GoodRx has done over the years is have these partnerships with different providers, with different pharmacies. I wonder now that you're working as a tech platform, how that changes the potential up and downs that you see with loss of contracts, and now that you're integrated, how that changes the potential runway for the company.
Yeah, thanks. I think what that reflects is having our relationship with Walgreens, CVS, Walmart, not just be based on a contract, which is here's certain price points of drugs, but more importantly, how we can manage that on a real-time basis to have a retail pharmacy, like my Walgreens example earlier on cold and flu, reach a bunch of goals. And so I'd say we are at the very early days of being fluid, fast, and flexible to work with retailers to provide benefit to their customers.
Certainly a good time to be in on data collection and data processing. GoodRx CEO Scott Wagner, thank you so much for joining today.
Thanks for having me. Really appreciate it.
All right, and thanks so much to our own Anjali Khemlani for bringing us that conversation. Shifting gears here, let's go to the cloud. Cloud software company Nutanix is seeing its shares climb today after raising its full-year guidance and reporting GAAP operating profitability for the first time in its second quarter. For more on this, we've got Rajiv Ramaswamy, who is the Nutanix CEO, back with us here on Yahoo Finance. Rajiv, always a pleasure to grab some of your time here on the day. Investors rewarding this particular quarterly performance here. What do you think was one of the largest catalysts that really sticks out, and does that continue to have some legs going into the rest of this year?
Yeah, I think three factors drove our outperformance. And first of all, we're proud that this is the seventh quarter in a row we're doing this. First, we have a strong and growing base of renewals and happy customers who want to continue doing business with us and expand. Second, we've been very disciplined about our operating costs and controlling them carefully. And this combination has led us to raise our free cash flow guide as well as our top line guide for the year. And third, from a demand environment perspective, there's a couple of things happening. First, companies are now operating more and more in a world that's hybrid multi-cloud. Apps and data are everywhere, and they need a platform like ours to help them manage that complexity and run their applications as it's critical to their business. And also, our biggest competitor VMware just got bought by Broadcom, and that's creating a lot of concern among our customers, and we are starting to benefit from that fallout.
Yeah, Rajiv, if you could talk a little bit more about that, because you mentioned the recent actions of Broadcom, how that's created a significant multi-year opportunity for us. Walk me through just what you see that opportunity looks like in terms of new customers and in terms of winning even more market share.
Yeah, I mean, clearly, I think post the acquisition, customers are now expecting higher price raises. They're seeing partners, their channel partners being disrupted. And so many customers have been engaging with us to figure out how they can reduce their dependence. And we are perhaps the simplest and easiest alternative for companies looking to reduce their dependence on VMware. So we've had lots of conversations with many, many customers who weren't prior customers before. Now, at the same time, though, this is a long-term multi-year opportunity. Many companies signed multi-year deals with VMware just before the acquisition closed. And then an infrastructure modernization effort and migration effort does take time. It's not just overnight. Sometimes there's hardware refresh cycles associated with it. And then also there's always, a land and expand motion for us. Companies will start by making a small investment in our platform, and then they will grow over time. So for all these reasons, it's a long-term, multi-year opportunity that we see here and are benefiting from.
Significant jump here that we saw year over year in free cash flow. As you kind of model out even further into the rest of this year, where do you continue to reinvest some of that cash back into the business for further growth?
Yeah, we are continuing to invest. In fact, for many years, we were holding our OpEx very flat, but this is the year we are investing, and we are investing prudently. We're investing in our R&D efforts, continuing to drive innovation, and we're investing in sales and go-to-market to capitalize on this opportunity from a demand perspective. So both of those, we are putting money back into the business, and we're still very much focused on achieving both long-term growth and sustained free cash flow generation.
Rajiv, what are you seeing just in terms of that demand? Break it down even further for us, whether it's on a regional basis, whether it's on even within here, the U.S. Where are you seeing that demand coming from? And I guess how is that then impacting your strategy then going forward?
Yeah, I think the demand is very broad-based. It's not specific to a particular region. We operate globally across all theaters here, US, EMEA, and Asia Pacific, and it's pretty broad-based. It's more fundamentally driven by the fact that every company out there is going digital. And as they go digital, it's modern applications that they have to go build, and they need a modern platform to run those applications. And those applications and the data they need and consume and generate are everywhere. They're running these in the public cloud, they're running it in their data centers, they're running it in the edges. And even if you look at some of the most modern new things they're doing with generative AI, it's the same story, right? Starting out perhaps in the public cloud, but really running where the data is, which is on-prem over time and also in the edge, and moving to inferencing. So these types of factors are fundamentally driving an investment cycle for our customers in terms of modernizing their infrastructure. And that's what we are seeing in terms of the benefit to our platform.
And so does AI then, in that case, just create one more cloud within this broader kind of multi-cloud ecosystem that a lot of companies are operating on top of and trying to connect all those data pieces? How does that, in connecting that additional AI or generative AI inferential cloud, translate into monetization for your business?
Yeah, in fact, where we come into play with respect to running AI is that AI needs to run where the data is. And data is everywhere. Some of it is sitting inside customer data centers. In fact, the most precious data usually sits there. And then there's a lot of data being generated at the edge that needs to be analyzed, and you need to drive inference. So companies need simple solutions to run these AI workloads, and that's what we provide with Nutanix's GPT in a box, as we call it. And it's still very early days. Many of our customers are still experimenting with generative AI, although they run traditional AI workloads. And so we look at this as companies trying to become more efficient, drive more productivity for their people. And we think this is, again, another long-term trend that's very, very early days.
All right, Rajiv Ramaswamy, thanks so much for taking the time to join us again here on your earnings report, CEO of Nutanix. Thanks.
Thank you, Brad and Shauna.
Weight Watchers International shares are plunging off nearly 24% after announcing that Oprah will no longer serve on its board. Now, she has been serving on the company's board since 2015. Weight Watchers also reporting its most recent earnings report, forecasting full-year revenue that fell below the street's expectations. There is some concern about the popularity of GLP-1s and exactly what the popularity of weight loss drugs is going to do for a name like Weight Watchers here. But digging into these numbers, Brad, that we just got from this report, you have revenue down 8% from a year ago. Subscriber numbers were down 5% from just the previous quarter, falling to 3.8 million. So you have the exit of Oprah. You have the fact that sales are under pressure. Not as many people are signing up for Weight Watchers. That all begs the question as to the impact that the popularity of weight loss drugs has on Weight Watchers and what they need to do in order to offset some of those headwinds.
Yeah, I mean, Her Media Highness Oprah had also even admitted or publicly disclosed that she uses some weight loss medications. At the tail end of 2023, that news came out. So ultimately, it is one of, and as you so rightly laid out, it is perhaps one of the largest considerations that a Weight Watchers has to think about in terms of the number of people that are choosing other options rather than a Weight Watchers long form program. However, within this announcement as well, they did note specifically that she has been an inspiring presence for Weight Watchers International, passionate advocate for the members, critical insights, counsel that's helped shape Weight Watchers over the last 8 years as well. It's hard to remember that from this brand prior to Oprah, I mean, because Oprah really was kind of like that Midas touch on top of so many businesses. Weight Watchers was another one for an extended period of time, but then there are some other broader kind of market factors that certainly do factor in as headwinds for the Weight Watchers business, and we'll have to see how they navigate that in this near term too.
All right, we'll keep it right here on Yahoo Finance. Coming up, shares of CRH hitting a record high after reporting its most recent quarterly results. We're going to take a deep dive with the company's CEO next. Shares of building materials company CRH hitting a record high this morning. You can see the stock up just about 4%. The company reporting its full year earnings results. Now, they were driven by demand for construction projects, also improved pricing strategies, helping to lift their most recent numbers. So for more, we want to bring in the CEO of CRH. We have Albert Manifold joining the conversation. Albert, it's great to have you here. So I want to start with inflationary costs. It was one of the things that was pointed out within your report here, saying that despite the continued inflationary cost pressures throughout the year, you were able to expand your margins and you were also able to deliver further growth in profits. How are you navigating the very persistent inflationary environment right now, and what does that mean for your business in the long run?
Well, first of all, Sean, thank you for taking the time to talk to us this morning. As you say, we announced our results this morning, and the reaction on the stock market is a reaction to a very strong set of results with revenues ahead by 7%, EBITDA ahead 15%, and indeed EPS ahead by 30%. That's our 10th consecutive year of both profit and margin growth. So the business is really humming. With regard to your comment on inflationary costs, and our business really is a business that actually provides more complex construction solutions rather than commodity products. So we're always working on increasing the value we give to our customers, we serve our customers with. We don't just provide basic commodity products. We actually turn those basic materials into complex construction solutions. So we get paid for the value, and that's how we've been able to drive the margin last year and indeed for the 9 previous years.
How many of those complex construction solutions are waiting for interest rates to be more favorable to begin some of those projects?
Well, actually, about 50% of our total activity here in the US is infrastructure spending, which is both federally and state funded. And as you know, the infrastructure has been long underinvested here for many years. And in recent years, there's been bipartisan support for long-term infrastructure spending to upgrade the infrastructure, which is necessary for the economy. That's not really exposed to interest rate exposure, nor indeed the second part of our largest part of our business, which is for non-residential construction. That makes up about 25%. So those two areas are 75% of our total construction demand. And that non-residential construction really is a real positive for the US economy, because what we're seeing is the reshoring and onshoring of critical manufacturing techniques back here to the US. Some of the largest companies in the world building chip manufacturing, data processing centers, in terms of biotechnology, pharmaceuticals, electric vehicles, electric batteries, all of that coming back to the US. And those projects are multi-year projects. So again, neither of those two businesses are exposed to interest rates. Residential is, and residential has been very slow, but that's the smallest part of our business. But even as our business is only firing on 2 of the 3 cylinders, we've still been able to produce those results that we've announced here this morning.
Albert, real quick, I know you just said that residential is a very small part of your business, but I'm curious what you're seeing there. Obviously, it has been one of the factors that has weighed down the overall performance, although just a bit. But when do you expect to see that rebound?
Yeah, I think the slowdown in residential, the subdued nature of residential is an affordability issue. Demand is very significant. I mean, the US has got an underbuild of 5 million homes as we stand here this morning. And it's clear to us as interest rates lower, you will see more and more people come back into the market. There's a need for housing going forward here in the United States that will stretch on for decades. So it's just a timing issue more than anything else. The fundamentals are still very strong. But as I say, even with a very subdued residential market, our strength in our infrastructure markets and our strength in our non-residential markets have to deliver the excellent results we saw this morning.
Albert, when it comes to pricing power, what do your pricing trends look like? And are you benefiting from some of the industry's tailwinds?
Look, there's no question about it. We are seeing a golden age of construction. We're seeing unprecedented federal support for infrastructure spend. We haven't seen anything like this since the New Deal in the 30s, and that's going to continue on for the next 10 years. That combined with the non-res growth I spoke about is very supportive of demand. And what we are seeing, though, is we're seeing a changing face of construction. More and more people are asking for us to construct in a more sustainable way, to build in a more resilient way, to build quicker, cheaper, and face the real challenges we're faced with. There's a lack of labor out there, so more and more we've got to manufacture construction products off-site and in factories. All of that plays to our strengths in that we provide complete solutions. We're the largest road builder in the United States, and we don't just supply the rocks for that road, we actually build the road. So when a state does business with us, we take it from the rock all the way to the finished road, and actually we guarantee that road and actually we maintain that road. And people want those complete solutions, and we're getting paid for that.
A really critical business. Albert Manifold, CRH CEO. Thanks so much for taking the time.
Thank you for your time this morning. Thank you.
Certainly. Well, shares of Best Buy rising on its latest quarterly results. We'll dig into the report with an analyst on the other side of the short break. Best Buy reporting fourth quarter sales that were better than feared, prompting the positive stock reaction. Enterprise comparable sales declined 4.8% during the quarter. That's compared to estimates of 5.3% of a decline. The retailer also increasing its quarterly dividend. Overall, the business outlook anticipates industry sales stabilization this year. Here with more, we've got Sean Dunlop, who is the Morningstar equity analyst here. Sean, thanks so much for taking some time here this morning. First and foremost, I want to get your read in on the report and if the worst is behind Best Buy.
Yeah, I would say a pretty decent earnings all in. It was $14.65 billion in sales, which edged FactSet consensus. Adjusted earnings per share were $2.72. That was obviously better than consensus, better than our own estimate. I think more importantly, as we look forward, the firm had the confidence to raise its dividend. That looked safe, and -3% to flat comparable store sales for the year to come is positive. With a $169 million restructuring, the firm is looking at flat operating income margin for the year to come, which is quite a bit better than we'd expected, and certainly better than you would expect given the sales environment that the firm still finds itself in. So on balance, looks like we're starting to hit some of those replacement cycles from the COVID pull forward. Could be that we're through the worst of this patch for Best Buy.
So for through the worst of the patch, and when do you expect to see a return to growth? Is that something that you see playing out before the end of the year?
Yeah, I think so. So during the first two quarters, I would expect that we would see negative comparable store sales. The firm obviously continues to close stores at sort of a 1% to 2% annual clip. They plan to close another 10 to 15 this year. I think as we move into the back half of the year, Q3 is where we're starting to pencil in real growth year over year for Best Buy. And Q4, if we teased out the impact, they had an extra week in this last year's Q4, but if you tease that out, we would expect growth for the year to come.
Where in the key categories that you're tracking are going to really prove that Best Buy can get back to some of its golden days, if you will? Because appliances, that still got hit hard in this most recent quarter. And we're still looking across where the consumer environment actually leads some of the spending back into the categories that were distressed, at least in this most recent Q4 here.
Yeah, it's a great question. I think we're going to continue to see pressure in categories like appliances and home theater. Those have longer replacement cycles. So if people bought those in 2020 or 2021, they're not going to need to replace them in the near term here. The other factors, obviously, we've seen quite a bit of a slowdown in the housing market, and there's natural replacement that occurs with that. So I think we'll probably see it first with laptops. The good news is we're starting to see that now. Best Buy cited positive unit volume over the most recent quarter within their sales base, and there really wasn't a refresh. There weren't any new features. There wasn't much innovation that would drive an upgrade cycle, which means that could be read into as just being a natural replacement cycle. So I think we'd see it in laptops first. I think as we move forward, we'll start to see it in phones, and then it'll spill over into some of the other categories over time.
Sean, are we seeing an inflection point when it comes to laptops and PCs?
I think so. Yeah, I certainly think we'll see it as we move through the first half of this year and into the second half of calendar 2024. I think that's where we're really going to see it. Obviously, consumer electronics are a little bit unique categorically. So if I'm a consumer and I have a phone and I've owned it for 3 years, I can pretty comfortably defer an upgrade for another year if I need to, if macroeconomic pressure remains stout. And the trouble from an industry perspective is that you don't get that sale back the way that you would in some other categories. So if consumers continue to feel pressured, they can defer some of these replacement cycles. I think we will start to see it. We're seeing an increase in real hourly earnings across the board. Obviously, there's some room to go in terms of recovering savings rates. Home starts are obviously slow. Interest rates remain high. Revolving credit balances remain high. But we are cautiously optimistic about the health of the consumer as we move into the balance of the year.
And then just lastly, while we have you here, Sean, I mean, we think about the year of stabilization, year of sales stabilization that the company is banking on here. What does that look like in terms of what investors should expect for the stock price continued trajectory?
Yeah, I mean, I think given the market's move today, obviously the stock is up 5 to 6%. That brings us into a range that we'd consider fairly valued. So as you think about it from the perspective of investors, you're looking at roughly a 5% dividend yield. You're looking at repurchases, I think $350 million of repurchases in the year to come. That's probably what you're looking at in terms of total shareholder return. You're not going to see tons in the way of capital appreciation for the year to come. That would probably be how I would encourage investors to think about it.
Morningstar's Sean Dunlop. Thanks so much for taking the time here today, Sean. Appreciate it.
Appreciate it.
Thanks. Coming up, what are the top hotel stocks for 2024? We'll dive deep into that next as part of Yahoo Finance's Travel Guide 2024 Industry Insights.
The SEC is investigating internal communications from Sam Altman, the CEO of OpenAI, to see whether or not the company misled investors. This is according to a report from the Wall Street Journal. Now, the SEC issued a subpoena back in December following accusations from OpenAI's board that the CEO wasn't consistently candid in his communications, and subsequently fired and ousted Sam Altman for a time. A lot of that was over transparency questions there. But this report here from the Journal, it's all over what they're scrutinizing some of those internal communications by Altman. They're looking into this, looking into internal records from current and former officials and directors in the ChatGPT creator, and also just trying to see what exactly was playing out surrounding that shocking move that played out at the end of last fall, and exactly what was known and what was not known.
Yeah, absolutely. I think one of the huge things around this, and anytime you have an allegation come forward like this, it really is, and it kind of harkens almost back to, and not saying that they're apples to apples here at all, or that anything that's been determined here, but anything that comes out from this, I think naturally about the misleading of investors that took place with Nikola. Now, I'm not saying that this is anywhere in the same realm as that, because there are clear advances that OpenAI has been able to put forward, clear solutions that they've been able to put into the market here. But now it's tied back to the dollar amount that they were able to either raise or that they were able to see compensation for during the fiscal year on the back of some of the advancements that were perhaps put into the minds of investors who were putting funds into the company on a capital basis, or even some of the core clients that they go out to as customers as well.
Yeah, we have SEC officials here in New York conducting the investigation. They've also asked, like we pointed out before, some senior OpenAI officials to preserve internal documents. This is all over whether or not investors of OpenAI were misled, and a lot of that surrounding the temporary ousting of their CEO, Sam Altman.
Well, let's also talk about Salesforce here this morning. Salesforce reported an earnings beat and announced its first ever dividend, but forecasted weaker than expected fiscal full year revenue here. Now, the chief financial officer noted that Salesforce was not factoring in material contribution from AI products, expecting to see it in 2 or 3 years. For more on how investors can discern the early beneficiaries of generative AI, let's bring in Fred Havemeyer, who is the Macquarie Head of U.S. AI Software Research. Fred, always a pleasure to speak with you, get some time here. First and foremost, with Salesforce and how they're going to be able to see this factored in to the financial performance in the future, what should investors expect as to the timeline when that'll really pass through to some of the margins that we're seeing this far?
So with Salesforce, firstly, I think what we saw is that the company is once again committed to delivering margin, delivering profitability, and doing all of the things that we believe are really critical for the story as a profitable growth story, one that is prudent about investments and costs. Now, we're very excited about generative AI, where that's going to go and how Salesforce can benefit from it. But big picture, we think that the ramp up to material contribution to revenue will take a bit of time. And this is consistent across all of our coverage. We think that generally enterprise adoption of generative AI software will begin to take off in 2024, but then ramp further into 2025 and 2026. Our base case here is generally that enterprises are beginning with testing generative AI software. They're not necessarily going to deploy it everywhere at once and let customers and their employees just use it immediately. Rather, they want to be careful and take their time on ensuring that generative AI products are both safe, reliable, and responding as one would expect and one normally would get from an employee of their own company. So I think it's extremely exciting, but we're going to be patient about where and when revenues appear from AI in Salesforce's model.
Fred, one of the big headlines out of this print was the fact that the company declared a dividend here, following in the footsteps of Meta. I'm curious from your perspective, analyst perspective, obviously, what that tells us about the confidence within management, about the future financial success of Salesforce, and how big of a boost do you see this being in the long run?
So with the addition of a dividend here and the company also consistently returning capital to investors through buybacks, what we're seeing is that we believe Salesforce here is really showing their dedication to deploying their cash flows in ways that are rewarding investors and their confidence in Salesforce. And so where the company is focusing again on profitability and cash flows and growing those cash flows nicely north of 20% year over year in 2025, fiscal 25, they see this as an opportunity to return more cash to shareholders. And I think that it adds a very nice aspect to this story, that you can follow along for the growth, for the upside from AI, but you're also being rewarded with both more margin, more profitability, more cash flows, and at the end of the day, more cash being returned to investors.
You know, I want to go further down that line here, because as we think about where companies like Salesforce, companies like Microsoft, Google are putting their AI products or solutions out into the market and seeing where some of their clients hop on what the generative AI prompt experience can look like that creates an output and ultimately creates these co-pilots that come to be expected within the workforce. Who is winning the battle of the co-pilot right now?
I think it's so early days that it remains an open field. I think in terms of the technology, OpenAI still appears to be in a position where they're serving the best models. Microsoft, we think, is leading the charge with productizing these as co-pilots and delivering them to enterprises. But overall, I think what we've also seen recently with how Gemini has been in the news and responding to prompts with outputs that many have begun criticizing recently, I think that it really shows, like the Gemini responses, for example, show how businesses are likely to be very careful with how they're adopting AI, because they need to ensure that the output coming out accurately reflects what their businesses are saying, doing, and their data, their positioning, et cetera. So I think that in this testing phase, we're very early days. I think that Microsoft, Salesforce, and the like, but Microsoft especially, is the furthest along here and is winning presently the co-pilot debate. But nevertheless, it's extremely early days, and we think it's an open field for competition.
All right, Fred Havmeyer, Macquarie, head of U.S. AI software research. Thanks.
Thank you.
Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Hospitality stocks had a great year in 2023 thanks to a boom in international travel rebounding. But can they outpace the S&P 500 in the months to come? Is your next vacation accommodation in a Marriott or an Airbnb? Which gives you the best bang for your buck? We'll look at RevPAR, discuss demand in China, and ask if the post-pandemic leisure boom is set to hold up. Yahoo Finance's Travel Guide 2024 Industry Insights asks the questions you need answers to. Do you even RevPAR? How can we play the hospitality trade? Joining us now as part of Yahoo Finance's Travel Guide 2024 Industry Insights, we've got our very own executive editor, Brian Sozzi.
All right, when it comes to making money in the biggest hotel names in 2023, it was a relatively easy endeavor. Ride most all of the stocks because revenue per available room was rocking as hotel operators pushed through higher prices, with stocks mostly due to cautious commentary from booking sites Expedia and Booking Holdings. Take a listen to what Expedia's CEO, who's outgoing, told us about current demand trends.
The markets are slowing a bit. The travel market, it's still growing, but it's the post-COVID thing is slowing down a bit, so the acceleration is lower. Really, Asia and Latin America have been driving this past year more than anything, and that's all slowing down. It's really just a decel of the whole globe back to sort of more normal post-COVID levels.
All right, so what does this all mean to investors in the hotel space? It means investors have to move beyond the outsized focus on revenue per available room and look for bullish company-specific attributes. And we, of course, have your guide for that one. I think the other way of looking at this is you actually have to do some work this year, guys, to find a good hotel stock. Lucky for you, I'm going to tee this up, and it's all free. So it's 3 bullish indicators. First up, hotels that are buying back a ton of stock and paying dividends. Usually, I think in this environment where things are slowing down, these are the shareholder-friendly actions you would like to see. I look at Hilton. I look at Marriott. Hilton last year, $2.5 billion given back in terms of capital to shareholders, eyeing $3 billion this year. Marriott, real whopping number here, guys. $4 billion in capital returned to shareholders last year. That's dividend and stock buybacks. Looking at about $4.1 to $4.3 billion this year. So lots of good things there from both of those companies. Bullish indicator number 2, hotels that are aggressively building pipelines, not pipelines to underground stations. It is pipelines to opening more rooms. Hilton added more than 130,000 rooms to its pipeline in 2023. Looking to add even more rooms this year. You have Marriott added 164,000 rooms to its development pipeline in 2023. Right now, that company's pipeline stands at a record 573,000 rooms. That's just a massive number, guys. And the last bullish indicator, number 3, hotel leadership teams staying hungry for more. I love execs that are just going for it all. They're not hungry with prior success. That's just my thing. And I love seeing this. And I see it really in 3 names. Marriott, like I've mentioned here. I look at that company's executive team pushing into Las Vegas, finally with a new MGM loyalty deal that will probably boost the loyalty program for Marriott, which is already industry leading. Choice Hotels, I love that this company's gone hostile for Wyndham, and Wyndham is saying, no, we don't want you. Well, they may not have a choice because that deal might actually get done. And then lastly, Hilton, they recently signed an interesting deal with small luxury hotels of the world to push deeper into the luxury market, a new arena for them, luxurious vacation. So again, some 3 indicators here you want to be looking for if you want to pick some hotel stocks.
All right, well, let's talk about picking some more hotel stocks, and Ozzy, stay with us here because you just mentioned the 3 bullish indicators that you are watching when it comes to the best plays. Well, the rebound in corporate travel, it's also a key theme that analysts are watching. It could have a big impact on the travel industry's winners and losers. Let's dive into it as part of our Yahoo Finance's Travel Guide 2024 Industry Insights. We are diving into which is the better potential play for your portfolio when it comes to hotels, when it comes to Airbnb. Here, as part of that, we want to bring in Michael Belisario. He's Baird, a senior research analyst, along with Brian Sozzi still with us here. Michael, let's talk about those names that are best positioned. So Saz just laid it out, buybacks and dividends, expansion plans, also aggressive management style, it sounds like. To him, at least, separates the winners and the losers. One of those names, Choice Hotels, I believe, is your top pick. What do you like about Choice Hotels, and what do you see in terms of that upside?
Thanks. Good morning. Yeah, with Choice, as you mentioned, they've gone hostile trying to acquire Wyndham. our view on the stock is it's sort of a win-win. If the deal goes through, and it's really up to the FTC at this point, both companies have sort of exhausted all avenues of from choice for their attempt, their Hothel attempt, and Wyndham from their defense. If the deal goes through, there's lots of synergies. Bigger is better in the hotel franchising business, and I think the public market is discounting lots of risks. And ultimately, I think 1 to 2 years out post-deal, people are going to be saying bigger is better. Look at all these synergies. They're going to be able to delever, and they're going to be able to buy back even more stock. And if the deal doesn't go through, we like the Choice standalone plan, the recovery in earnings, and their balance sheet's in phenomenal shape, and they're going to be able to buy back a ton of stock at a discount. So we view it as a win-win. It's very much an idiosyncratic story and call that we're making, but that's the setup we see for CHH today.
Michael, some folks I've talked to on the Choice Hotels Wyndham battle suggest that this Choice wants to make this deal to compete on loyalty with a Marriott and Hilton, get more rewards members. Why not just go into a Marriott or Hilton, which are just larger companies? Are those the better plays?
Well, bigger is better. That includes loyalty. I think when you think about the hotel brand business, it's all about 1 + 1 is greater than 2. When you have more dots on the map, owners are happier because more demand comes through the direct channels. Developers have a greater incentive to convert or build hotels, and guests have more options to stay in, and there's a nice flywheel there. It's a different customer base for Wyndham and Choice in the lower end chain scales than for Hilton and Marriott. The Hilton and Marriott customer, a lot of times the business traveler is earning his or her points and then redeeming them at aspirational resort properties. There aren't that many of those within Choice and Wyndham's portfolio, and a lot of the rewards for Choice and Wyndham are something to the akin of stay 9 nights, get the 10th free, a little bit more of an immediate reward. But yes, bigger is better, and that includes the loyalty system. And I think when you look at Marriott and Starwood, when that deal closed in 2016, and now Marriott just hitting 200 million loyalty members, they can leverage that platform. You see it with what Hilton and Marriott are doing with their credit card agreements. They're taking the people and their most loyal guests, and they're creating ancillary fee streams and profit streams that are very, very valuable and very sticky.
Michael, take us to the other side of the trade here, too. When you think of Expedia, of course, parent company of Vrbo, and then you've got Airbnb, what levers can they pull in this environment where we were laying out some of the pipelines that Marriott, Hilton have that they're going to be continuing to bring to market, whereas the other two are really focused on just making sure that people are listing their properties?
Yeah, there's a much greater focus on the supply side there. So when you think about Booking, Expedia, and Airbnb, very much focused on the leisure traveler. Leisure travel continues to normalize. I know that's an overused word, but people are still traveling. People are still spending money. Yes, the growth rate is slowing. I know you played the clip from Peter, but it's still positive and it's still good. And travel broadly is gaining a greater share of people's wallet. They're not buying houses and they're not buying washers and dryers anymore. They're spending in other things. Whereas the hotel brands, particularly Hilton, Hyatt, and Marriott, they benefit from business travel still recovering and large citywide group and conventions still recovering too. So there's much more of a business tilt to the demand side of the pie for the hotel brands, which is why the stock prices are still performing the way that they are.
All right, Michael Belisario, Baird, a senior research analyst. Thanks so much for taking the time to join us here this morning. And of course, our thanks to Brian Sozzi as well. Just about 90 minutes into the trading day, you're still looking at gains for the S&P and Nasdaq. A bit of relief on Wall Street following that PCE print this morning. The Dow, though, just below the flat line, off about 40. That does it for us today, but keep it right here on Yahoo Finance. Rochelle and Akiko have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita, and here's what I'm watching at this hour. Inflation cool down, stocks push higher as the Fed's preferred inflation gauge comes in line with expectations. What this means for potential interest rate cuts from the central bank. Goodbye, Oprah. Shares of WW International, also known as Weight Watchers, plunge as the talk show host leaves the board and sells her stake in the company, the firm facing increasing competition from obesity drugs like Ozempic. And going small to address the housing crunch. Pending home sales dropping 4.9% in January, according to the National Association of Realtors. We're going to be taking a closer look at the boom in ADUs, or granny flats, as some call it, in the face of tight inventory. The CEO of Samara is going to be joining us later in the show. First, though, let's take a look at where major indices are trading 90 minutes into the trading day. By the way, the last day of February here. The Dow trading pretty flat right now, but the S&P 500 up about 10 points and the Nasdaq up 69. And of course, this on the back of that PCE print coming in pretty much in line with expectations. Let's take a look at where Treasury yields are right now. We have seen a pullback in those yields, the 10-year year up 4.23% and the 30-year yield at 4.36%. Well, core PCE, personal consumption expenditures, the Fed's preferred inflation gauge, logged its lowest annual increase since March of 2021 in January, while monthly prices rose at the fastest rate in a year. While there is still work to be done on curbing inflation, our next guest believes we are inching closer to the finish line. For more on the latest inflation read, let's bring in Tuan Nguyen, RSM U.S. economist. Tuan, good to talk to you today. How does this latest print fit in line with where you expect the economy to move?
So it's definitely good news that the year-over-year inflation numbers are going down. But a lot of people are focusing on the month-over-month and even the super core that show stronger print than last month. We're not too worried, though, about the strong inflation print in January because all the seasonal factors and also the spike in housing inflation, which if you look at it, is more like noise than trend. So I do think that, however, that given the rebound in energy and gasoline prices, we might see another strong number for inflation in February ahead of the Fed's March meeting. But even if that's the case, we don't expect any kind of sharp rebounds that really change the calculation for rate cuts in 2024. We think housing inflation will eventually come down in the summer and offset any kind of increases in goods inflation or energy inflation that everybody is concerned about. So if you look at the overall picture, we think that there are a lot of reasons to expect inflation to ease further in the summer.
So put the January numbers in context is what you're saying, just given the noise we usually see in that month. What does that mean in terms of when the Fed reaches that 2% target and when those interest rate cuts are likely to begin?
So in our estimate, we think that there's quite a good chance that we might actually get to 2% by mid-year for the overall inflation, PCE inflation. And for the core PCE inflation, we might settle around 2.5%, all because of that cool down in housing inflation. So that really continues to reaffirm our forecast that we made last December that we might expect a first rate cut around June this year. Now, if you look at what has happened in the past 3 months, we had some good inflation news and the market kind of jumped ahead of itself to price in earlier rate cuts than June. Now, the probability of rate cut, the first rate cut in June is about 70% in total, which is not 100%. So that is why we always want to stay away from changing our minds with only a few data points, especially after looking at the January data. And we think that the Fed is in the same boat. They are not going to rush to cut rates too early. And by the summer, we think that the Fed will have about 1 year of inflation data that really supports lower interest rate.
So you say core PCE expected to remain around 2.5%. Then what is the incentive for the Fed to cut, even if it's just in June?
So I think around June, again, they're going to have 1 year of inflation data. And by that time, I think the economy will cool down materially. And if you look at the labor market, if you look at growth, I think there are a lot more incentive to the Fed to keep growth steady, to keep the labor market strong. And now with that in mind, though, I think it's very important to specify the risk that the economy might continue to outperform our expectations. And one reason is that if you look at the stock market, it has been on a massive rally since last year. And I think it is time that we cannot ignore the wealth effect of the stock market. We just put out research note this morning on the impact of the stock market wealth effect on total spending. And the rule of thumb is for every increase in stock market wealth, every $1 increase in stock market wealth, consumer spending increases by 32 cents. And if you look at all the gains from dividend and asset prices from last year, that could potentially account for 1 to 4% increase in total annual GDP on a nominal basis. So the bottom line is we don't think the Fed is in the position to rush cutting rates this year. So the risk is we might see 3 or even less than 3 cuts in 2024 if the economy continues to outperform.
So a rate cut in June or no rate cuts at all?
We think a rate cut in June, and then the Fed will have ample of time to think about the next rate cut after June, and they can even spread out the rate cuts like what they did with the rate increases that we saw last year. So just to slow down the pace of the rate increases. So this time they can slow down the pace of rate cuts so they don't have to cut too much in 2024. Now, on top of that, we think that the Fed has the kind of luxury that they haven't had for quite some time. That is because of the increase in recent productivity might actually work well into the Fed's favor, that not only it will boost growth, but will keep inflation down at the same time. So I think, again, the Fed can really take its time to cut rates.
Tuan Nguyen, RSM U.S. economist, it's good to talk to you today. Appreciate the time.
Thank you.
Well, congressional leaders say they have a plan to avert a government shutdown, at least for now. The short-term bill funds the government until March 8th and March 22nd. To break this all down for us, Yahoo Finance's very own Rick Newman is here. We're back to a short-term funding bill, Rick.
Yeah, we should point out we are 5 months into the government's fiscal year. Republicans said one of the things they were going to make a hallmark of their control of the House of Representatives this year was we were going to get back to regular spending bills. In other words, you pass a spending bill for the whole year at the start of the fiscal year, October 1st, and then you don't have to go through all of this nonsense. But of course, that hasn't happened. So the short answer to what's happening now is Congress has not yet passed the permanent spending bills, but there's reporting that the leaders in the House and the Senate have come up with some kind of agreement. What they're going to do is another short-term spending bill, but apparently they do have enough agreement on the basic priorities that during that time, the next few weeks going into March, they will actually get the full spending bills done. And if this reporting is all true and nothing blows up, then I guess by the end of March, that means the government will be funded all the way through the end of September. And then after September, I guess we just start up with this whole thing all over again. But basic takeaway here is that the odds of a government shutdown are rapidly declining. They're not zero because something could always go wrong here, but it looks like the government's just going to stay in operation.
The other big story we're watching out of D.C. today, Rick, is what's playing out in the Senate. Senate Minority Leader Mitch McConnell announcing he is stepping down from his leadership post, although we should point out he's planning to serve out the rest of his term. Who is in line to replace him, or I should say which one of the Johns are in line to replace him, and how much influence do you think the former president Donald Trump is going to have on this decision?
Right. There are 3 Johns, as everybody in Washington is talking about. It's Senator John Cornyn of Texas, John Thune of South Dakota, and John Barrasso of Wyoming. I guess you might say that Cornyn of Texas might be the early favorite. These are guys who have a lot of experience in the Senate. They've worked pretty closely with Mitch McConnell. It doesn't look like we're going to have some upstart who would be able to get enough votes. I mean, the Senate obviously very clubby. They want to go with a known quantity. So get around to the question of Trump. This is a very interesting question because so McConnell is going to serve his 2 terms here. First is his term as Senate Majority Leader, which basically ends in November, and the Senate Republicans will actually choose their new leader after the elections in November, and that's when McConnell's going to keep the job until then, and then he will no longer be a minority leader or the Republican leader, but he's going to stay in the Senate. Senate as a senator until his term is up in 27. But this election for the new Republican leader will come after the November elections, which will tell us two things. Who's the president going to be? Is it going to be Trump or is it going to be Biden? And also, will Republicans take control of the Senate and have a majority? So I'm not so sure that Trump is going to be calling the shots here the way he seems to be calling the shots with regard to what Republicans are doing in the House. He basically seems to be channeling himself straight into House Speaker Mike Johnson, refusing to bring up the Ukraine aid bill for a vote, for example, refusing to vote for a bipartisan immigration bill. That all seems to be Trump's meddling. I'm not sure he's going to have that much influence. Now, if Trump wins in November, I suppose it could be a different story, but there are a lot of things to factor in here, and we're not going to know a lot of this until November, obviously.
Okay, still a lot of time until November. Rick Newman, as always, thanks so much.
See ya, Kiko.
Well, coming up, we're going to be looking at real estate pending home sales data out today, and we're going to be asking if the future of housing is in smaller structures. That conversation is coming up after the break. Pending home sales out this morning, declining 4.9% in January and declining across all U.S. regions year on year. Let's bring in Yahoo Finance Danny Romero to give us the details. Danny.
Akiko, the drop in contracts signed in January really reflects the winter weather rather than a decline in demand. Remember, buyers avoid colder weather when buying a home, while others are expecting low rates to actually drop during the spring season. But remember, Another reason why there is this drop in January, some economists were saying that there could have been a pull forward in sales from January into December. Remember, December saw an 8.3% gain, which was revised down to 5.7 due to the favorable weather. But back to the January results. If we compare this to a year ago, pending home sales is still down 8.8%. And on a monthly basis, contracts signed in the Northeast and in the West rose, while in the Midwest and the South, those dropped. Why? The southern states and the states in the Midwest are experiencing really strong job growth than compared to the rest of the country. And while that also means that a lot of people are looking for long-term living, however, inventory still remains the issue at hand. Now, there is some good news. Redfin reported that during the 4 weeks ending February 25th, there was the biggest jump in new listings in nearly 3 years. That was almost a 13% gain there. Total inventory is improving. However, housing costs still remain high. The typical mortgage right now payment is $2,671, which continues to crush those home buyers, and also those elevated mortgage rates is no help right now with sales. Akiko.
Yeah, those mortgage rates certainly hurting prospective buyers there. Danny Romero, as always, thanks so much. Well, as Danny pointed out, home sales may be down, but home prices continue to remain elevated. The latest S&P Case-Shiller Home Price Index pointing to a 5.5% increase in 20 major markets. The lack of inventory has been a key contributor, and that has led to a big boom in the build-out of accessory dwelling units, or ADUs. California recently passed a new law allowing homeowners to sell ADUs, and our next guest is looking to capitalize on that by building customized units for prospective buyers. The company Samara, born out of Airbnb's R&D unit. And let's bring in Mike McNamara. He is the CEO of Samara. And Mike, you guys have a big announcement today about acquiring a factory over in Mexico so you can vertically integrate the operation. What does this mean about your ability to respond to this demand?
Yeah, hi, and thanks for having me here. We did just announce that we brought on 150,000 square feet in Mexico to actually build our units. And what's really exciting about that is that we now, within our company, we design, we engineer, we manage supply chain, and we now manufacture the units that we build. And these are, we design and we install these beautiful flexible living spaces that people can use in the backyard, and gives them more ways of being able to, operate their life's activity. So the fact that we actually own our manufacturing is really interesting because we now can control the quality, we can control the on-time delivery, we can control whatever products we want to put into it, and our product development cycle time gets much more rapid because we control all those aspects. So very excited to bring that online.
And Mike, for those who haven't necessarily been following Samara's story or this growth in ADUs, talk to us about what kind of units we're talking about. How big are these units, and what's the price point you're looking at?
Yeah. Like I mentioned, we like to think about we're a company that helps people with new ways of living. And one of the most important ways of living is to have a flexible living structure that maybe you can put into your backyard. So what we do is we design these small homes, if you will, which, today we have a lineup of a studio, a 1-bedroom, 1-bath, a 2-bedroom, 1-bath, and a 2-bedroom, 2-bath that we're actually announcing this week. And these are anywhere from 400 square feet to 800 square feet, and you can pop these into the backyard. So if you think about an extraordinarily flexible way to add living space to your home, you already have a backyard, you've already bought it, it's already part of your cost structure. Why not be able to use your yard in a much better way, both financially and qualitatively? So what we do is we build these units. As I mentioned, we'll build these in Mexico, and then we just drop them onto the backyard. And the entire process takes literally like 6 weeks to actually be in your backyard, do the construction of, so we can hook up the utilities and then be able to truck in the unit into the backyard.
And Mike, for years, we have seen ADUs serve as a way for homeowners to be able to get additional income, being able to rent out that space, especially with home prices so high in places like California. We've seen a change in regulation that allows for homeowners to now sell those units themselves. What has that meant for Samara specifically? Has that pushed up demand even more?
Yeah, and what's really driving this is the California home prices, as you know, are very high. And with high home prices comes high rental income. So the ability to bring on more housing units is a real objective of California. They've passed many of these different regulations and laws that enable, and dozens in 2016 that enable customer or homeowners to be able to add this capacity to the backyard. About half the time, the customers may use these for rental income. And because you've already bought the land, you've already owned the backyard, adding just the cost of the unit itself onto the backyard and be able to get full rental income is very attractive, and it almost creates an immediate free cash flow impact for many areas of California. And so what California does is trying to stimulate this housing, more and more housing units. It's affordable by nature because the units are smaller, so they tend to rent for less or they cost less to build. And so it appeals to many different customers. But the demand for these ADUs on the back of all these law changes since 2016 to now has gone up right about 20x. And it's like currently the largest permit, the permit request for this form factor is the highest of any form factor in California right now. So it's a way for them, and it's a tool, it's a vehicle that they make these law changes, and that more and more people will take advantage of it because the economics are so strong, and that it's one way to address some of the housing shortages in California.
So, Mike, California's led the way on this, but there's obviously a lot of other markets that have been looking specifically at ADUs. For Samara, where are your other growth markets right now within the U.S.?
Yeah, we think it's going to pretty much start with California just because of the housing stress. But even independent of the housing stress, this is kind of a representation of a new way of living. So only half the time they're actually rented out. But to actually have this flexible living space right in your backyard allows you to do many different things to actually operate your life. The average homeowner in California is there for like 17 years. And over the course of 17 years, you might use it for income on demand. You might rent it out for 3 months or 6 months or next year or 2 years from now at your convenience. But you also might bring your parents back there to live. You might use it when your kids come home from college to help them get started. You might use it for a yoga studio. It might even be a pandemic someday. And, work from home is going to become a thing. But all the while that unit sits in that backyard, you're appreciating. I mean, it's actual real estate. So you would expect it to appreciate right along with the front of the house. So just in terms of a very cost-effective way to bring on the opportunity to either have income on demand or to be able to use it in many different ways to just design a better life for yourself is very high. So when we think about the other regions, get back to your question on what are the other growth markets, certainly anywhere where there's going to be housing stress is helpful. But we also think that this is a form factor that people are going to use to operate their life in the future. So independent of the housing stress that may be occurring and the incremental rental rates that are going on, we do think people will adopt this as a different way of living, to have this super flexible space, to be able to have 500 square feet in your yard, use it for many different ways over the course of the decades, and also be able to rent it out.
It's been pretty impressive to see some of these ADUs and open houses I've gone to. Oftentimes looks better than the actual main unit. But Mike McNamara,
you need to come ours.
Talk to you today.
Yeah, thank you.
Yeah, I'll definitely have to check out Samara's build out there. Thank you so much for joining us today.
Okay, thank you.
Coming up, we're going to be taking a look at major names in the healthcare services sector and the best plays moving forward. That's coming up after the break. TD Cowen out with a new note on the hospital services sector, finding hospital revenue grew up close to 8% year on year, driven by inpatient and outpatient activity. That firm notes that this year may seem some moderation. So what are the strongest plays for investors in this space? Let's bring in Gary Taylor, TD Cowen, Senior Equity Research Analyst, to discuss more. Good to talk to you today. Let's start by talking about this growth story. How much more runway do you think there is?
Hi, good morning. Thanks for having me. It's a good question. I think we are going to see hospital revenue growth moderate, and it's so important to us to track not just for the market cap in the sector, that's the actual hospital or provider stocks, but you have exponentially more market cap, which is the health insurance companies. And these costs, this hospital revenue growth, this provider revenue growth, is the medical expenses that the payers have to pay for. So it's really important to both those sectors. Overall, I think there's one more really good month. I think February will be good. It's going to be driven by leap year. And then as we get into the rest of the year, starting in March, the comps get so much more difficult that we expect we are going to see this revenue growth moderating for providers, and therefore the medical expenses moderating for the health insurance companies.
Yeah, you pointed out in your note that you think this trade is in the late cycle right now. With that said, walk me through some of your top picks on the back of this growth.
Sure. Depends on time frame. Obviously, depends on risk appetite. But in the very near term, we came into the year saying we want to own the providers over the health insurers for the first half of the year, and anticipating that by the time we pivoted to the back half, we'd be in a position to want to recommend payers over providers. So we're currently still in the first half of the year. Obviously, we're still in that provider trade. Our favorite names are HCA, largest hospital company in the U.S., Acadia, which is one of the largest freestanding behavioral providers, and then also Surgery Partners, which is an ambulatory surgery center company. The only insurer that we've kind of bumped up into that top category this early in the year is Humana. And that's because Humana's had terrible news. They've cut their earnings guidance in half. The stock's gone down 40%, and we're opportunistically wanting to take advantage of that stock being lower.
So for those who are watching this, not necessarily following the trade so far, what's a good entry point when you think about some of those names that you just highlighted?
Yeah, well, for the provider trade, I think it's a little late. So if you're a retail investor and you're looking at HCA, for example, HCA in November was $225 going into its investor day. People thought the outlook was terrible. The stock's now at $310. This isn't a great entry point in my view. If you have a multi-year view, long-term investor, best company in the healthcare provider space, absolutely own the stock. Don't care much about entry point. But honestly, we'd probably like to see that back at the 280, 290 range to be more opportunistic outside of just owning it for the next month or two. On Humana, we think below $400 is pretty interesting. The stock's at $350. There's one more piece of negative news that could come out in April. The bear case is it would kind of take the stock to the 320 range. But the reality is we think Humana in 18 months is worth somewhere between 450 and 500. So if you're dollar cost averaging an entry point anywhere here in the next month or two at a 350 or lower, we think that's pretty attractive.
United Health, one of those names that you mentioned as, one of the top picks. We got the announcement yesterday that the DOJ has launched an antitrust investigation into the company. How should investors be looking at that headline right now, and how big of a risk is it?
Yeah, well, United's not one of our top picks right now. We are recommending the stock, but it's not one of our top picks. Honestly, what we're concerned right now really is more the near-term fundamentals of the company. We think it's likely they missed the first quarter medical loss ratio. We do think there's at least mid-single-digit earnings risk for United for 2024. We don't think they've guided particularly conservatively. We'd be looking again to add to that a little bit lower heading into the back half of the year. But with respect to DOJ, I'm less concerned about it. Honestly, we see some political motivation here. We know there's some ties to these Senate staffers, senators, that don't like health insurance in general, that particularly think United is problematic, and some ties to the DOJ. So honestly, it looks a little bit politically motivated. And just from a fundamental perspective, we don't believe there's a lot of markets where United would be violating traditional antitrust horizontal standards. So to make any real case is going to rely upon some of the more novel vertical theories of harm that the FTC and the DOJ have promulgated. And honestly, they've been pretty unsuccessful with those in the courts of late.
Gary Taylor, TD Cowen, Senior Equity Research Analyst. Good to talk to you today. Appreciate you stopping by.
Great. Thanks for having me.
Well, coming up, WW International shedding revenue and a big name from its board. More on that story after the break. Wendy's is pushing back against claims it's implementing surge pricing in its menus. In a recent earnings call, new CEO Kirk Tanner announced plan to integrate AI in its menus to give the fast food chain more, in his words, flexibility in its offerings. The company now says that's not the equivalent of raising prices based on demand. Let's bring in Brooke DePalma, who's following this story for us. And Brooke, of course, when we hear surge pricing, we think about Uber, when the prices go up when demand is higher. Wendy's saying that's not what we intended at all.
Yeah, Wendy's saying that exactly, Akiko. And you've probably seen the memes across the internet where people said, hey, can I pay about $2 less, or rather the price of a Baconator that it was only 2 hours ago? Now Wendy's saying, whoa, 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 that is absolutely not the case here, with no plans to raise prices when customers are visiting the most, like we see with surge pricing like Uber and Lyft. Rather, Wendy says it plans to use AI technology, like you said, to have the flexibility to change menu items on digital menu boards and offer value and discounts during the day. Now, this all kicked off, as you said, when CEO Kirk Tanner, who, keep in mind, just was named CEO this month, said beginning as early as 2025, we will begin testing more enhanced features like, keep this in mind, dynamic pricing, they called it, and day part offerings, along with AI-enabled menu changes and suggestive selling. That, along with plans to invest $20 million to roll out digital menu boards to all U.S. company-owned restaurants by the end of 2025, and plans to invest nearly $10 million over the next 2 years to support digital menu board enhancements. That includes order accuracy and upselling opportunities, which means suggestions to customers like, hey, do you want to add a Frosty or cold brew or water, among other menu items to your order. They also hope that by changing up menu offerings and implementing value throughout the day, it'll lure in more customers during slower times of day, like maybe breakfast and afternoon. But overall, Akiko, this has truly taken a life of its own, created so much buzz across the internet about just how AI technology can impact the way fast food companies offer value, set pricing, and ultimately engage with consumers, taking a life of its own. But now Wendy is saying, hey, we're not raising prices during the busiest times of day.
Okay, it's going to be a lot of eyes
on
the new menu board when it goes up. Brooke DePalma, thanks so much. Well, WW International, better known as Weight Watchers, shares tumbling today. This comes after Oprah says she will not stand for re-election on the company's board in May. The health management company reporting fourth quarter revenue down 7.6% compared to a year ago. For more on this, let's bring in Linda Bolton-Weiser, D.A. Davidson Managing Director. Linda, it's good to talk to you. The context or the background to all of this, of course, Oprah has acknowledged that she has been able to lose a lot of weight using those GLP-1 drugs. And you've got still what looks to be a very bullish price target on Weight Watchers. You changing that target at all in light of what's played out today?
No, not at all. In fact, I raised my operating profit estimate for 2024 by 20%. And I kept my 2025 EPS estimate the same at 60 cents a share. So really my price target stays the same. I do think that there's a lot of media attention today being put on the whole Oprah issue, but she's been reducing her stake in the company for quite a while now and distancing herself. And actually, the press release said that part of the reason she is stepping off the board and donating her remaining stake is that she doesn't want there to be the appearance of a conflict of interest as she talks about her use of the GLP-1 weight loss drugs. So I think there's a lot of attention being put on that and not enough attention being put on the operating results of the company, which are actually improving.
So the Oprah decline, we should say, that may be a little oversold, but there have been real concerns here about Weight Watchers and its ability to compete in the market in light of the surge that we have seen in demand for GLP-1 drugs. What do you think investors are missing?
Well, I think what investors are missing is that there actually has been a turnaround in the core business. So the GLP-1 and their clinical business is an important part of the story, but it's certainly not the whole story. We estimate that the GLP-1 business, what they call clinical, will represent 20% of revenue in 2025. So the majority of the business is still the core business. And people have been concerned with declines there in the last few years, but that business has actually stabilized and is actually growing core subscribers. And so I think that's kind of what people are missing here is that you've got an improving core business, and then you've got the added icing on the cake of the rapid growth of their clinical business.
So let's go back to that price target you mentioned. $12.50 a share is what you're looking at right now. What are the key catalysts that will get it there when you consider where the stock is trading today?
Sure. Well, I've actually got low single-digit core revenue growth in 2024. And then in 2025, I've got 10% revenue growth, because that's when clinical becomes a bigger portion, and clinical will probably still grow 50%, I would say, in 2025, slower than it is now, but still a good growth rate. And also their gross margin is expanding quite a bit as the business shifts from workshop to digital. And as they improve the scale in the clinical business, that gross margin will improve from a little over 30% to probably getting close to 40%. So you've got a number of gross margin drivers, you've got improving top line performance, and right now they're proving they can keep marketing spending stable and do the growth initiatives that they're planning.
Linda Bolton-Weiser, D.A. Davidson Managing Director. It's good to get your take today. Appreciate you joining us.
Thanks.
Coming up, Cava sells strong results in the fourth quarter, crushing same-store sales expectations. We're going to speak with the CEO, Brett Schulman, after this short break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Well, shares of Cava hitting a new high today. The fast casual chain doubling down on growth, now planning to open another 48 to 52 locations this year. That would bring its total footprint to 309 stores. Cava showing strong customer traffic in its latest report, with same-store sales climbing more than 11%. For more on the company, we're joined by Cava CEO Brett Schulman, along with our very own Brooke DePalma joining in on the conversation. Brett, it's good to talk to you today. We're talking about a bump in the stock today, but overall, year to date, your stock is up about 38%. What do you think investors are liking about this growth story?
Yeah, well, it's great to be with you. And I think what people are seeing is that our results are reflective of how we're able to demonstrate the power of our category-defining brand, that unique Mediterranean cuisine where taste and health unite, the extraordinary potential, the white space potential in front of us, and the way our team was able to deliver outstanding results and deliver on our strategy as we expand across the country.
Good morning, Brett. You are working towards a long-term goal of opening 1,000 restaurants by 2032. What is the right cadence of openings here? And with that projection of 48 to 52, do you anticipate that you'll ramp up in 2025?
Well, we've stated that we are projecting 15% compound annual unit growth with a goal of 1,000 restaurants by 2032. So it's actually a bit of a moderation from our 72 net new restaurants we opened in 2023, which is why we feel really comfortable about our pipeline and our ability to maintain this growth rate.
And people ordering in person at these restaurants is actually more than the people ordering online. You don't hear that too much these days as well. But as you think about the restaurant design moving forward, what is that optimal mix of people ordering online and in person? And do you anticipate maybe a shift here or an increase on either part?
We've seen it be pretty consistent, where 64% of our guests choose to come into our physical space to interact with us, and then 36% of the time they want to opt into one of our digital channels, whether that's having our great Mediterranean cuisine brought to their house or their doorstep, or coming around to one of our 31 digital drive-through pickup lanes, or simply walking in and picking it up off the shelf after they've ordered on our digital app. So we don't think it's an either or, we think it's an and. We can have great digital channels as well as great physical channels, because our cuisine works at lunch, it works at dinner, it works for singles, it works for families. So what we find is our guests, we want to give them a multi-channel environment where they can opt into their channel of choice depending on what their need is and what day of the week it is or day part it is that they want to engage with us on.
Brett, here in California where I am, we are expecting that big bump in wages for fast food workers come April, going from $15.50 an hour to $20 an hour. I mean, that's a significant bump. What does that mean for Cava? Bottom line, are you concerned that this could trickle down into other states who are looking at California, the organization among the workers, to see if the wages could get pushed higher in other states as well?
Yeah, well, we've always taken the philosophy of investing in our team members, investing in our guests, and that creates long-term shareholder value. We can go all the way back to our early days and back to 2016 when we took our starting national wage to $13 an hour, which is when many of our peers were paying $9 and $10 an hour in the markets we were operating in. We've obviously taken significant wage increases since. And so as it pertains to Southern California and AB 1228, whose predecessor was the FAST Act, we've talked about we're going to absorb that 30 basis point impact, not pass that expense along to our guests. We view it as an investment in our team that will create restaurant level growth, restaurant level margin growth over the long haul.
What's the assumption the company's operating under, though? Is this specific to Southern California, as you said, or are you likely to see, or California, or are you likely to see those wages push higher in other states too?
Well, we've always aspired to pay better than average wages and be competitive and have attractive wages in every market we operate in. we're constantly reviewing that to make sure that we're competitive and that we're attracting our team members and supporting them, whether it's with the headline wage or whether it's with supplemental and ancillary benefits, whether it's mental health benefits that we rolled out 2 years ago, paid time off to vote in the all-important election we have coming up in November, or other community service philanthropic benefits that we offer.
Brett, you guys did increase menu prices by about 3% in January of this year. What is the current average price for a Cava pita wrap or a bowl? And do you anticipate that changing once again later on this year?
Yeah, so we took about 2.5% to 3% approximate price as the only planned increase we have for the year. And as I mentioned, we do not plan to take any outsized pricing to offset the impact or the unplanned increases in California. And the average PPA is around $14, and this includes many premium attachments. So we've talked about over the course of last year, the growth in add-ons like our harissa honey chicken or those craveable pita chips and the fresh juices we make that go so well with our food. So our price point has allowed people to trade up into those premium options and still stay within their budgets.
So what's your sense on how much pricing power you still have when you consider how much your customers are still spending in stores?
Well, we think we have pricing elasticity, but again, we don't want to just take it because it's there. We want to put the best value proposition forward for our guests. We saw the data last week. Food costs or food as a percentage of consumers' disposable income is at a 30-year high. We understand the pressures our guests are facing all around them. So we want Cava to be a place where they can come and get a little relief from those cost pressures and get a great value for what they're purchasing and a great value for their dollar and a great value for their body as well.
I do want to quickly hit on the cost of your food basket right now. You guys are rolling out steak nationally this year. How will this impact the cost of your current food basket?
Yeah, so we see it as dollar margin neutral, maybe not dollar percentage neutral, but dollar margin neutral. So our steak offering is a premium item and it will be priced as such. So again, we see it as dollar margin neutral to our basket.
Brett, I want to go back to the question around sort of wage increases, but it is really about cost increases overall. We've seen more and more fast food operations integrate automation, especially with the advancement of AI. How are you thinking about that piece right now and the investments that you're making on that front?
Yeah, we want to always incorporate technology to enhance the human experience, not necessarily replace it, but make our restaurant operations more productive, be able to put that great value proposition in front of our guests. Two examples of that. One, super excited that we brought online last month our new state-of-the-art 55,000 square foot production facility in Southwest Virginia. This is in addition to our existing facility in Laurel, Maryland, where we are able to produce our chef-crafted dips and spreads, think tzatziki and crazy feta, and we're able to do it at quality and consistency at scale, taking that complexity out of the four walls of our restaurants and delivering that great value to our guests. And our facilities will support at least 750 restaurants and additional growth. So that's one example. And then as it relates to AI, we announced our Connected Kitchen initiative, which we're embarking on a multi-year journey where we believe we can take our foundational labor deployments and layer on top the use of data and generative AI models to get even more sophisticated and efficient and optimized with things like predictive prep, predictive cook, labor scheduling and inventory ordering. So again, it takes the complexity off of our team members' plate, puts them in a position to be more successful in delivering great food, great service, minimize out of stocks, minimize food waste, and bring just-in-time fresh food to our guests, which ultimately delivers an enhanced guest experience, keeps our guests coming back and coming back more frequently.
Brett, when we first chatted, when you guys went public back in June, you said that you had no plans to increase your CPG business. Do you plan to rapidly provide growth in the CPG business? Could we see dips popping up in other grocery retailers this year? And in addition to that, are you eyeing another facility, despite the fact that 750 is quite a ways away?
Yeah, so we are in about 650 grocery outlets today, and we are slowly growing that business. The new facility in Southwest Virginia gives us production capacity to have that optionality. Again, no current plans to, but look forward to taking advantage of that opportunity down the road.
Brett Schulman, Cava CEO, joining us alongside our very own Brooke De Palma. Thanks so much for joining us today.
Thanks for having me.
Let's do a final check of where the markets are trading on the back of that PCE data that came down today. The Dow's still down just slightly here, with the S&P 500 and Nasdaq firmly in the green. That does it for me in this hour. Much more to come here on Yahoo Finance. Keep it right here.